I'm Jason Stipp from Morningstar. We're well into earnings season for the first quarter, and as Morningstar analysts are digging through the filings, we've pulled out a few interesting themes we wanted to share with you. Here with me to talk about that is Morningstar stock investor editor Paul Larson. Thanks for joining me, Paul.
Thanks for having me again.
So already we're starting to see the flood of earnings come in. It's just getting going, but we've had a couple of weeks now where we've gotten some reports, and you said that you have some themes that you've pulled out. So, broadly, what are some of those things that you're seeing? Let's just take it from the top.
Right. Well, there have been several common denominators that we've noticed. One of the things that we've seen is we've seen a lot of one-time charges related to the recent healthcare legislation, and this is something that is primarily affecting old line companies that have been around for a long period of time and have a large number of retirees. Companies like Verizon, AT&T, Caterpillar, Boeing. These companies have had very material one-time charges that have taken a bite out of first quarter earnings. Thankfully, it's really a one-time event and shouldn't really affect things too much moving forward.
Another thing that maybe is short-term is a currency effect is giving some companies a nice bump. Tell us a little bit about that.
Right. You are seeing the dollar is weaker than it was a year ago, so you're seeing a bump from currency effects helping companies that have operations overseas. Companies this week that reported like Coca-Cola and Pepsi seeing a couple percentage point increase in their revenue growth rate over and above what it is on a constant currency basis.
So as a long-term investor, how do you think about these currency effects? I mean, obviously it's working in their favor now, but that, no one can predict. It might change. How do you factor that into your thinking about a company?
Well, this is a cyclical factor that is going to help them in some quarters and is going to hurt them in some quarters. And just right now, it happens to be helping them.
So it may be more of a wash over a longer term.
Absolutely.
Okay, so moving on to something, speaking of cyclical, you've noticed some trends with retailers and also companies that are discretionary versus non-discretionary. It's kind of interesting about where we are in the recovery right now. What do you see there?
Right. Well, companies that are selling discretionary items are doing relatively better than those that are selling non-discretionary items. It's sort of the inverse of what we had in early 2009. The consumer is back, and their wallets are open, and consumers are spending.
Speaking of that and the where we are in the recovery, I feel like some of the management teams have been reporting, something more positive than they've seen in the past, and that they're starting to talk about growth again. Is that something that we can sort of hang our hats on at this point?
Yes, it's interesting. A year ago at this time, we were talking about green shoots, and there was a great debate on whether or not those green shoots were real or not. Well, I think there's no debate now that those green shoots were indeed real, and we are seeing very little discussion about the recession. Of course, there are exceptions. Construction companies or companies that have heavy exposure to the overall labor market are still hurting, but for technology companies or manufacturing companies, you're seeing some very positive commentary and frankly results coming from those particular companies.
So digging into their results, obviously some of these companies are seeing business pick up and they're getting busier and busier. How is that playing out in their productivity?
Productivity is going through the roof right now. We are seeing across the board margin expansion, and this is largely a reflection of the cost cutting that we saw in 2009. Now you overlay that with a spurt in revenue growth that we've experienced with the economic recovery, and the companies really haven't started hiring back employees. They're just working their existing employees that much harder, and that's why you're seeing this margin expansion.
So companies got lean and mean, and now it's really paying off for them. How sustainable, though, do you think that is? I mean, how long are they going to be able to push their employees to work that overtime as business is picking up?
Well, I think you hit the nail on the head there. They can do it for a little while, but after a while, they're going to have to start to add back some of the benefits that were cut, and also start giving people raises again. And after that, they're going to have to start actually hiring again, and these are going to weigh on margin. So it's nice that we have the margin expansion right now, and also that we've been able to draw down the inventories. But eventually, those things are going to have to go back up.
But we will at least hopefully see some improvement in the unemployment rate.
Yes.
Well, thanks so much for joining me and for your 30,000-foot view, Paul.
Thanks for having me.
From Morningstar, I'm Jason Stipp. Thanks for watching.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.